Good morning. This is Dylan Jovine from Behind the Markets. Happy Wednesday. So a lot of folks have wrote in over Labor Day weekend to ask what I thought of Buffett selling Bank of America and why he's selling it. Is Bank of America in trouble? Is it a bad company? Is there any real reason to sell it? And I just figured I'd touch on that for a minute here. We got another two questions yesterday. So look, I mean, my job is to serve you, serve our members to the best of my ability. So anyway, so Buffett selling Bank of America, again, I'm not Warren Buffett, I'm not in his head, but here's the basic rule. When the Fed starts to lower interest rates, bank profits go down. And that is because let's say the Fed borrows money at 1% and they lend money out at 5%. When the Fed starts lowering rates, their margin, the spread between what they get money at and what they lend it out at starts to shrink. Bank stock profits are going to go down if the Fed keeps lowering rates, period. That's a law of economics. It's not a Dylan Jovine rule. It's not a theory. This is just the way it is. Banks make money by lending money, and when the amount they are able to charge for lending money goes down, their profits go down. That's the bottom line. So Buffett's selling Bank of America in all likelihood because he knows the trade is done, at least in the short term. And that's one of the reasons why we haven't recommended any bank stocks in the past few months. We did recommend Bank of America last year. We sold it last year for a nice little gain, not a home run, but it was a nice base hit, maybe 35%. But we haven't recommended any bank stocks, except one exception. In Breakthrough Wealth, we recommended a special situation, but that is a very special situation. But generally speaking, if I own bank stocks that were short term that I picked up in the past couple of years, I probably would be selling them, generally speaking. Again, if you own JP Chase for 20, 30 years, and this is one of those things that you're holding on to, I would not sell that. But I'm saying if you picked up some bank stocks to ride the interest rate run, now is the time to sell them, in my view. That's just my opinion. Because profits are going to go down. And they asked Jamie Dimon, the CEO of JP Chase, the other day, his opinion on doing stock buybacks for JP Chase, and he kind of laughed and said our stock is too expensive. And that basically tells you everything that you need to know about whether you should be buying banks, especially big money center banks. But general speaking, banks that lend money for business, that's their core bread and butter, whether it's lending money through home loans, whether it's lending money through credit cards, whatever it is, their profits are going to go down as they are able to charge less for the money that they are lending out. So that's my opinion. The only exception, again, I have to that rule for those of you who are watching this that own Breakthrough Wealth is that special situation in New York that we picked up a few months back. But that is a very special, unique situation. So generally speaking, I would be out of banks. Now, again, I want to make this perfectly clear to preempt any questions that we might get about this. If you own a bank for 10 years, 5 years, 20 years, you're not doing a short-term movement of interest rate cycles. Don't even think about this. Banks go up, they go down, they go up, they're down, cyclical based on interest rates, basically an expansion of the economy. I wouldn't even touch it. I wouldn't even think about it. But if you own a short term, if you bought it in the last year or two, you've ridden the cycle up, this is the signal to sell. When the Fed starts to lower rates, bank profits will shrink. I mean, that's just kind of the way it works. And frankly, you have an incentive to sell anyway, because the tax regime could be very, very different next year. Remember, we have $5 trillion in tax cuts expiring, basically the Trump tax cuts that he put in when he was president. They were set to sunset after 8 years. So they sunset basically after next year. So they're going to go away. So basically that means that there's going to be a lot of haggling about how to do this so it's not such a big hit to the economy, even though, as you guys long know, we're running crazy deficits and it's not sustainable. So I'm a very, very, very big believer in not running deficits like we're fighting a two-front war, because we're going to hit a wall very, very soon. We're going to hit a wall sooner than later by running those kinds of deficits. But if the Democrats take power, the tax regime will look different than if the Republicans take power. Not that I want to talk about politics, because Lord knows you don't need me to talk to you about that. You have your own opinions on that, and everybody does. And my mom always taught me never to talk about religion or politics in public. So I'm going to stick with that. Anyway, the takeaway here, the headline is, if you've owned bank stocks forever, don't even think about it. But if you've owned bank stocks and you've just owned them for a year or two or three, and you've ridden the interest rate curve, I probably would be out of them because their profits are likely going to go down on the Fed lowering rates as their profits go down. The only exception here that I have is that one small New York bank that we recommended, because that is an incredibly rare special situation and a long-term special situation at that. Have a great day.